Hello everyone, this is Ejaz Khan and it's our sixth lecture of Strategic Business Leader paper of ACCA. Before we start our today's topic, as our usual lecture format, I would just like to give you a quick recap of what we have studied so far in our last 5 lectures. As we were discussing the strategic planning model proposed by Johnson, Scholes, and Whittington, according to which a strategic planning model or strategic planning process should have 3 stages. In the first stage, the company has to analyze its strategic position against the environment it is operating in. This stage includes both internal and external analysis. The internal analysis is basically the identification of the company's strengths and weaknesses. That is, the things that the company is good at and the things that the company is bad at. And then external analysis, which includes the opportunities and threats that the company foresees in the environment. Now, why is it important to have this strategic position analysis? Well, unless and until a company knows its strengths and weaknesses and the threats and opportunities in the environment, it cannot come up with a strategy that will help the organization to convert its weaknesses into strengths, to use its strengths to avail the opportunities, and to use the strategy to avoid threats or to convert the threats into opportunities. So it goes without saying that strategic position analysis is a core area of strategic planning process. So once the strategic position analysis is done, then the company will have to identify strategic choices. That is, the options that the company will find most effective, most useful to achieve its objectives. This particular stage will identify the potential strategies that the company can follow in order to achieve its overall objectives and to stay relevant in the business. Once those strategies have been identified, then there will be an evaluation process and a strategy will be chosen. The chosen strategy will now be implemented in the third stage of strategic planning process. In the third stage, the company has to create an environment in the organization so that the new strategy fits in and becomes the overall part of the organization. In the previous lectures, we have discussed the external analysis, the macro level analysis with the help of Pestel and Porter Diamond, the micro level analysis with the help of Porter 5 forces, which was basically the industrial level analysis. And then we also discussed the SWOT analysis. We've discussed the usefulness of SWOT analysis in identifying the company's strengths and weaknesses and opportunities and threats. We also discussed Porter value chain, in which we discussed how to identify non-value adding activities and how to identify the weaknesses in those activities so that the company can improve those activities or replace those activities with new activities and hence improve its value creation and quality of the product. Then we also discussed Porter's generic strategies. That is, once a company starts the process of planning or starts the process of making strategies, it has to decide which generic strategy is going for. And we discussed three basic strategies proposed by Porter, which is the cost leadership, the differentiation, and the focus strategy. We will continue with that strategic planning process in our today's lecture as well. And our today's topic is the BCG matrix, which is the Boston Consultancy Group matrix. The BCG matrix is basically a very useful tool when it comes to making a particular strategy for a company to succeed. According to the BCG matrix, it's very important to categorize the company's existing products portfolio into 4 categories before a particular strategy could be chosen for a particular product. According to BCG matrix, a company cannot have one strategy fits for all. So it has to have different strategies for different products. But before it chooses a particular strategy for a particular product, it has to categorize its products into 4 categories. Those 4 categories will depend on 2 factors. One factor being the relative market share, and the other being the rate of market growth. According to BCG matrix, we can divide the relative market share into 2 categories, low or high, and we can also define the rate of market growth as low or high. And based on these variations, we can categorize the products into 4 categories. Those 4 categories will be star products, the question marks, cow, and dog. Now the cow, which is actually the cash cow. So there are 4 categories in which the products could be placed. And when we say the rate of growth, market growth is the potential of the market size to grow. We see few of the markets as non-growing, the saturated markets where there is no more growth left, it's already saturated, so we call it a low growth market. Whereas there will be markets which will be significantly growing, and the market size will be continuously growing. So we can say it has a high rate of growth. On the other side, when we say the relative market share, it's actually the market share of the company compared with the overall market size. We can calculate it as the number of units sold for that product by the company as a percentage of total units sold in that market. For example, if a company is selling 10,000 units against the total sales in the market of $100,000 units, it means it holds 10% market share. Now, if the company is market leader in that particular product and holds the highest market share, we can say that it has a high market share in that market. But if it has a significantly lower share as compared to its competitors, then we can say it has a low market share. So based on these variations in the rate of market growth and the relative market share, the products will be categorized into these 4 categories. Now let's say we take product A, one of the products of a company. Product A, let's say the company is having a high market share for this product. That is, it's a market leader for this product in the market. And this market has a potential of growth, and it is growing at a very good rate. So the market size for this product is growing, and we are the market leaders in that product. So we will call it a star product. Why we call it a star product? Because we are the market leaders in this product, for this product, and there is a potential for this market to grow as there is a high growth rate in the market. So we call it a star product. And the strategy for this product will be to invest further so that the company can benefit from the growth in this market. On the other side, if the growth rate for this product, or the market growth rate of this product is at a higher side, but we are not the market leaders. We hold a very low share of this product, but the market is significantly growing. So what should we be doing for this product? Should we invest? Question mark. Why are we not able to become the market leaders? Why are we not the market leader? Again, a question mark. So we don't know whether we should be investing further into this market or into this product. Therefore, we call it a question mark. And the strategy will be to analyze the reasons why we are not the market leaders. Because this product is growing, the market is growing in this the market of this product is growing, but we still don't hold a good share. So it asks for analysis, in-depth analysis to find out the reasons. Now, if the reason is because we haven't invested much in this product, then we must invest further to become the market leaders and convert this question mark into our star product. Or whatever the cause may be for having a low share, we should investigate that and see if we can improve those weak areas so that we can convert this question mark into our star product. And what if we have a product in which we are not the market leader, and the market is already saturated and it has a very low growth? So we are already having a lower share, and the market is saturated. So should we invest in this? No, a big no, because if we're not the market leaders in this product, and there's no growth in the market, there's no point of investing further and wasting our capital. Because if we haven't become the market leaders, there's a less chance that we will become the market leaders. And even if we become the market leaders, the growth isn't that much that we will be taking this risk. So it's not worth taking the risk. So we will not invest into this product, and this product will be called a dog product, and we should divest from this, that is, kill the dog and take out our investment, sell this business unit and take the cash out of it. You may invest into star product. The cash that we will get from selling this business unit will either be invested in the star product or will be invested in the question mark product if the analyst asks us to invest further. Now, what if we have a high market share in a saturated market where there's no growth? So if we already are the market leaders and there's no further growth expected in this market, what should be done in this case? Should we sell this business unit? No. we should not be selling because we are the market leaders, and we will be getting enough cash flows from this market, from this product. So what should be done? Should we invest further? No, we should not be investing further because there is no growth expected in this market. And we are already the market leaders, so we can't go beyond this limit even if we invest. So what should be done? Just take the cash flows, the operating cash flows from this product. That's why it's called cash cow. Just take the cash flows from this product, keep this product in your portfolio, take the cash flows from this product and either invest in the star products or invest in the question marks. So you can see how useful this BCG matrix is in analyzing the company's products portfolio and how helpful it will be to come up with the most effective strategy for these products. I hope this was a useful lecture and I was able to correctly explain this matrix. Thank you for watching. Bye-bye.